Welcome to the 3 in 10 podcast. I'm Scott Slayton, partner and chief strategist at Capital Creek Partners. In each episode, I'll give my brief perspective on 3 things we think market participants need to know this week, and we get it all done in 10 minutes or less. For additional resources and analysis, please visit our website at capitalcreek.com. Welcome to the 3 in 10 podcast for Friday, January 30th. We're recording at 12 p.m. Eastern Standard Time. And here's your starting lineup. The U.S. dollar, the Fed meeting, and Kevin Warsh. So we'll start at the top with the dollar. We believe the dollar has started its next leg lower with a decisive break to 4-year lows. President Trump signaled he's comfortable with a weaker U.S. dollar. To quote him, "Just look at all of the business we're doing," unquote. Secretary Bessent tried to clean up the mess with comments that we believe in a strong dollar, but the die is cast, in our opinion. The market knows that the administration wants a weaker dollar. It always has. And the dollar was much weaker in Trump's first term. So we're just repeating that exercise. The explosion in metals prices have got to make investors question the dollar as a store of value. The world is once again refocused on the chronic budget and trade deficits being run in the U.S., where the CBO tells us that the U.S. may have $40 trillion in debt by the end of this year. Believe me, that $40 trillion in debt is not going to be repaid with stronger dollars. It's going to be repaid with weaker dollars. The rest of the world also knows the U.S. froze Russia's dollar assets when they invaded Ukraine, and maybe rightfully so. But that has caused the world to want an alternative to the dollar. It has caused international central banks and governments to diversify away from the dollar. Hence, the 250% move in gold over the last 3 years. So the dollar's already devalued against gold. Now we're in the process of a slow rolling devaluation against other fiat currencies. U.S. policy volatility is tarnishing U.S. exceptionalism, and it has reignited this debasement trade that was really in gear during the first half of 2025 and took the dollar down 10% last year. Dollar remains rich on most of the metrics that we track by 12 to 15%. So we think this currency has a long way to fall before this bear market is over. We project that the Bloomberg Dollar Index, BBDXY, will fall another 5 to 10% in 2026. And we see the euro hitting 130 this year. Probably most importantly for our listeners, a weaker dollar is bullish for equities. It's bullish for the U.S. economy. It's bullish for commodity prices as they get translated back into dollars. It's bearish for the treasury market because it erodes the value of that coupon. And a weaker dollar loosens global financial conditions, and that's the most important point. It stimulates U.S. trade exports, so it flatters GDP, depresses imports. It helps U.S. multinational earnings when they're translated back into dollars. And it encourages flows of money into higher returning assets like emerging markets. Now on to the Fed meeting. The Fed appears to be on hold for the first half of 2026. There's just simply less pressure on their dual mandate. The economy is growing pretty well. Inflation has improved a lot, but it's still stuck around 3%. And the labor market is evolving, not tanking. So we see no rate cuts between now and the end of May when Chair Powell steps down. We think cuts this year will still happen. Probably 2 to 3 cuts will happen, but we think they'll be back-end loaded, and we think the federal funds rate will end the year right around 3%. Now on to Kevin Warsh. I am somewhat surprised that the president picked Kevin Warsh as Fed chair in waiting. The president has been very clear that he wants a dove in this position, someone who will cut rates 300 basis points all the way down to somewhere between 0 and 1%. Well, we think he picked the wrong person because Kevin Warsh is a career-long hawk who has been wrong a lot in his career, especially at cyclical turning points. He's usually been on the wrong side of changes in the economy. Kevin Warsh was one of the last, maybe the last person on the Fed who wanted to lower rates as we were early in the financial crisis, and he was outright against the Fed expanding its balance sheet via QE as the crisis got underway. So we see Kevin Warsh, and we've watched him for many years. We see him as balance sheet focused. We see him as a fiscal hawk, and we see him as a traditional conservative. And none of those things really fit with what the president wants out of a Fed chairman, which is somebody who's going to just cut rates. So I do think that Warsh will get confirmed, but I think it's going to be a nasty political confirmation process. And we know that there are several Senate Republicans who do not even want to begin this process until the indictments at the Fed are resolved. And maybe not until even the Lisa Cook decision is resolved. So we think that it may be several months beyond May until Warsh can be confirmed. But we think he's going to come in as a hawk in dove's clothing, and he will need to be a dove until President Trump is either a lame duck or out of office. So Warsh is a confusing and contradictory pick by Trump, in my opinion. He has been very critical of the Fed as an institution since he left it, and he's going to need to mend some fences at the Fed to gain respect, to gain influence, and to be the true leader of the institution. So Warsh is not a friendly pick, in my opinion, for stocks or bonds based on his track record. And I am reminded of what Chairman Greenspan once said, that the job of the Fed chair is to forecast the U.S. economy. I don't think Kevin Warsh is going to be very good at that task based on his track record. So I don't expect Warsh to save the dollar because he has to be dovish until Trump is either a lame duck or out of office. So do the work, endure the pain of gain, and have investment courage.
The information in this podcast is educational and general in nature and does not take into consideration your personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategy or investment may be suitable for you, consult the appropriate qualified professional before making any final decision.